Imagine waking up, opening your portfolio, and seeing that millions of investors had billions of dollars in wealth shattered overnight. To understand a wipeout of this scale, we must look at the mechanics of Bitcoin's valuation. Without a central bank to manage the currency, its price is determined by the raw balance of supply and demand. But when buyers vanish and a massive wave of sellers enters the market, that equilibrium fails. The weight shifts and the price drops toward zero. So, what specific global forces caused the demand for crypto to disappear so violently in 2026? The answer shows that Bitcoin does not exist in an isolated digital vacuum. It is vulnerable to external, macroeconomic chain reactions. The first domino fell with the broader economy. In 2026, the United States maintained unexpectedly high interest rates to combat inflation. At the same time, institutional investors held massive amounts of cryptocurrency through Bitcoin ETFs, financial vehicles that allowed traditional funds to hold crypto at high volumes. When interest rates stay high, risk strategies change. A guaranteed return on a safe asset looks more attractive to Wall Street firms holding volatile cryptocurrency. In response, large-scale investors withdrew billions from Bitcoin ETFs, moving away from volatility in favor of safe, steady returns. That withdrawal flooded the crypto market with excess supply. With a glut of Bitcoin and the largest buyers leaving, the price floor collapsed. Large-scale institutional involvement changed crypto dynamics. Wall Street's shift towards safety now dictates Bitcoin's baseline stability. The billions of dollars exiting Bitcoin shifted immediately toward a different kind of growth. The 2026 AI sector grew as a magnet for investors seeking rapid returns, drawing capital away from other high-risk assets. Institutional wealth was redirected from the crypto ecosystem and into emerging AI and tech stocks. As that institutional money left, retail investors watched the initial price drop and reacted with fear. This triggered panic selling, an emotional reaction where small investors liquidate their holdings to prevent further losses. This panic created a self-fulfilling prophecy. What began as a calculated institutional move accelerated into an uncontrollable crash as fear spread through the market. The 2026 crash began with calculated institutional reallocation and was completed by retail fear. Looking back, the 2026 crash fits into Bitcoin's history of extreme boom and bust cycles. This chart shows those historical cycles. While severe crashes have been followed by recoveries in the past, market history does not guarantee what happens next. The 2026 crash shows that cryptocurrency moves in response to the same interest rates and technological shifts that drive the rest of the global economy. Because of these external forces, financial decisions require research rather than reactions to sudden panic or rumors. The pressure on digital assets is growing more complex. The question is whether Bitcoin can adapt to these market pressures and ever reach new heights again.